Hi everyone, Joe Lopresti here with our proactive strategy update for Friday, August 12th. Well, since our last update, and even going a little bit further back since our model's tactical buy signal on July 14th, the market has been in a rebound phase, in almost a one direction move back to the upside, recapturing some of the decline that was witnessed in the first half of the year. In this update, we're going to cover our recession warning models, as well as many of our proprietary market indicators, and share with you a discussion we're having internally about scenario A or scenario B playing out in the markets through the remainder of this year and probably into 2023 as well. So let's start out by looking at our recession warning model. So here you can see our recession warning model, and the lines on the chart indicate various predictions of 12-month forward, 6-month forward, 3-month forward, etc., of coming recessions. And this is our effort to predict a recession in advance using various individual economic indicators. The important signal comes when the lines cross the zero line to the downside. Right, so you can see our latest reading is still well above the zero line. This is updated through the end of June. And so far, our economic model is not yet warning of a recession. Right? Now, I want to be a little clear in what we are hearing in the media and what we think is important. What we're hearing in the media is, are we in a recession? That's the debate. We've had two negative GDP quarters back to back, and some people think that defines a recession. In our view, it's not really a matter of whether we're in a recession. It's a matter of whether we're going into recession in 3, 6, 12 months from now, because that is going to be pretty much the differentiator between whether the bear market that we experienced in the first half of the year is over and we're in the early phase of a new bull market, or whether that bear market extends on for several more months and experiences a few more down legs along the way. So we built our model warning of a recession well in advance, and you could see not even our 12-month warning is warning of a recession right now. Now, that could change quickly. We know that. But as of today, that's the way we see it. Now, let's take a look at some other recession models that are developed by outside organizations, because we're seeing some conflicting signals with those models. So now we're looking at work done by an organization called Recession Alert. Our opinion, they do a very good job. They build numerous different models, much more elaborate and complex than ours. One that we find helpful is called their U.S. Monthly Leading Economic Index. That's the blue line on this chart. And you could see it too, similar to our recession model, is declining, but so far has held up above the recession warning level. And you could see that's really what's important, is that model getting to the zero line, forward warning of a recession coming. That's what happened here in 2008. You could see plenty of warning, even going back into the early parts of 2007, that a recession was coming. Now let's switch to one of their other models, which is their weekly leading economic index. And a lot of lines going through the chart here, but it's the red one. If you could focus there, you could see really all of the lines on this chart are below the recession warning level. So these models are warning of a potential recession coming. The red line is the one that we're focusing on here. You can see the last couple of weeks, this is updated weekly versus monthly with the other index and with our model. There's been a bit of an uptick. So there's always a chance of a false negative. If we go back in previous times, for this long stretch here from 2009 to, the COVID drop, there was not a recession warning by the weekly leading economic index. You could see back here, again, prior to the 2008 recession, there were warnings at that time. So this one is in conflict with the monthly by the same organization and our own leading index. And finally, we're going to look at one other tool from Recession Alert, and that is their Recession Forecast Ensemble. This is a summary of 15 different recession models. And again, a lot of lines on the chart, but we're focusing on this black line, and you could see the bottom there and starting to increase into this year. And now it's shot up to 7 of their 15 models are warning of a recession at this point. That's a high number. They suggest 5 is a good call for a recession. In other words, if 5 of their models moves from not predicting recession to predicting recession, there's a good chance we'll have one. So there you have it. There's really inconclusive evidence at this point of whether or not we're moving into recession. Again, the question is not if we're in a recession. If it is, it's extremely mild and is not going to have this similar damaging impact on asset prices that more severe recessions would have. However, if we continue to deteriorate from an economic standpoint, we could move into a recession later this year or into 2023. And that's what matters, because bear markets or corrections with a recession are much more extensive in both the duration as well as the extent of the decline than corrections without a recession. And here's some statistics that prove what I just said. We're looking at all of the S&P 500 corrections of 10% or more since 1965, then separated out by those that did not occur alongside a recession. Those are the dark diamonds on the chart. Those that did occur with the recession are the red diamonds on the chart. So the average correction without a recession is about a 15% drop versus a 36% drop if a recession is coupled with the market decline. Even more important than that is the extent. We could see about 100, and these are business days. That's approximately 5 months in time without a recession versus 300 plus business days, 3 times the length of a recession-coupled bear market. So that's why we spend so much time focusing on the economy and whether or not we're moving towards recession. If not, the decline we experience in the first half of the year comes really close to meeting the average. About 5 months, was a little bit longer than that, but and it was also a little bit deeper of a decline than 15. But really, the story there is it could be over if we are not moving into recession. If we are, you have to brace yourself for perhaps another year or so of this bear market playing itself out, and many recession-driven bear markets are much longer than that, as you could see here. And really, after the rebound we've experienced, there's significant room to the downside for this bear market to play out if we do have a recession, if we're moving into recession. Another observation that we have to keep in mind is the valuation that stocks are trading at today. This is our market valuation model. We could see that the valuation got to its all-time high before a pullback. Now, this model has a delay to being updated because we're waiting for information from the government. So this is updated through March 31st, and in about another month we'll have all the data to update it through June 30th. And there's going to be more of a drop because we know stocks drop further in that second quarter of the year. But the decline so far has really only moved stocks back to the high in 2000, the previous highest valuation prior to the recent one. So if we're moving into recession, and again, we have to remember, in 2000, we moved into recession. And that was followed by a second recession in 2008. So stocks devalued over a 9 to 10 year period during that time before stocks got back to a reasonable value from a long-term investment perspective. Today, we're nowhere near that. Even if it's dropped a little bit more, maybe we're hanging, in this range as of June 30th. If we're not moving into recession, this may not be the high for the cycle of market valuations. Consider 1998 when there was a drop for a short period. There was a similar type of decline in the market like we experienced this year, about a 20% drop in the S&P back then. But because it was not coupled with a recession, valuations rebounded very quickly and went on to new highs a couple of years later. A similar thing could play out during this cycle. This may not be the high for equity valuations. If we do not move into recession, we think that's probably a pretty good assessment of how we would expect things to play out. Pretty quick rebound in the market and stocks moving to higher ground, higher than they were at the start of the year when this bear market started. But if we start a recession, a full-fledged cycle of market devaluation or re-rating stocks based on slower and longer period of weak economic growth, that is also equally likely. So, scenario A in our view is there's no recession. If there's no recession, then the market setup is potentially good for some upward movement into the end of this year and early part of 2023. Now, seasonally, there's still a couple of weak months in September and October coming up that we may have to get through before, experiencing that strong upward movement. However, if there's a recession, all bets are off with that call. We would expect markets to move more choppy and experience additional downward movement through 2022 and probably into 2023 as well. Well, I think a fair question right now is how can we avoid a recession? Many people are thinking that with the Fed, shifting to aggressively raising interest rates in ways they haven't done in 25 plus years and higher interest rates. They've stopped their money printing. In fact, starting next month, we're moving into a larger degree of quantitative tightening or reducing their balance sheet. So certainly there are going to be some headwinds ahead. However, we speculated on this in recent updates that inflation could roll over. We saw how commodity prices dropped really starting in about June. We speculated that could eventually filter into the inflation number starting to decline. And lo and behold, this week's inflation numbers were lower and in some cases significantly lower than were expected. So we could see that the U.S. Consumer Price Index year over year has come off of its high. Now that certainly is not much, but it could be the beginning of a longer term trend. The month over month number dropped and it actually was negative from one month to the next. Right? So that could cause the Fed to change quickly. This Fed is very short term in their thinking and data dependent. And in fact, they said that after their last meeting, they're going to base their decisions on the data and not give a lot of forward guidance. And it wouldn't surprise me in the least if maybe there's one more interest rate hike just to kind of ensure that these inflation numbers come down. But then they pause their interest rate hiking cycle, and that could very much support that scenario A with a no recession coupled market environment. We would expect to see a quick recovery in stock prices and really then opening up and taking the lid off of market valuations to continue to move to the upside into 2023. So now let's take a look at our proactive asset allocation dashboard. And we're going to see two changes on the dashboard since our last update. No signal changes, right? The major market cycle continues to be bearish based on our global sell signal April 22nd. Prior to that, in 2021, there were tactical sell signals indicating the market movement was unsustainable and eventually should correct back down. Then on July 14th, our same model told us that the bear market got to an unsustainable level and we're likely to revert back to the upside. And that's what's happened so far. So the two changes to the dashboard are, first, the cash comparison chart, one of our core indicators, has flipped back to positive. Now, we would call this a weak positive, right? Technically it's positive, but there's also times when it's clearly positive. Right now, I would say it's technically positive, but positive nonetheless. That is a change to one of our key indicators that drive our market cycle and signals. So from a core perspective, we really have a neutral with the universe trend indicator, a negative reading continues with the long-term momentum indicator, and now a positive. So conflicting signals from those core indicators. The other change is our overbought, oversold indicator has reached the overbought level within the context of a bear market, right? And I put that caveat in there because if we begin to move out of a bear market and back into a bull market trend, then the market isn't overbought, right? Because we look at it in a completely different set of data than a bear market trend. So here you could see, more evidence of conflict, right? Where we're seeing some of our core models and indicators beginning to improve. The universe trend indicator was the first that moved from negative to neutral. Now we have the cash comparison chart moving from negative to, let's call it neutral to slightly positive. So if scenario A plays out, we're seeing improvement with our core indicators, which could lead to a buy signal. This setup can potentially lead our model back into a buy signal. We need to see other areas of confirmation before that would happen, but it's possible. At the same time, our tactical indicators are getting high. Even the 10-week chart, while it's not technically high risk, it's getting there. It's at 68%. 74 is high risk. So today, possibly, this will be back to the high risk zone if the strength in the market, as we record here in the middle of the day, holds through the close. At the same time, the overbought, oversold indicator has reached that overbought area of its channel. So if scenario B plays out and we move into a recession-coupled market, then we may be reaching a point where there's profit-taking potential based off of this tactical buy signal a month or so ago and a really strong move in equity prices over the course of that month. So let's take a look at that overbought, oversold indicator. So here's the All Country World Index that we use for most of our indicators and a channel that we've developed that takes all of the previous times that our model was on a global sell signal or bear market conditions and calculates some statistics and data. So the blue line is the bear trend average, right? That's where we expect the yellow line to trade while we're on a global sell signal. You could see back here in June, it reached the oversold level for just a short period, had a little bit of a recovery and then a relapse, and that's when our model gave the selling climax signal, a tactical buy signal, just off of the June low. Since then, there's been an upward movement, and now you could see we've reached an overbought level, assuming that we're still going to remain in a bear market because this channel is built based on bear market statistics. Now we're taking this out and looking at approximately the last 5 years of this overbought, oversold indicator, and you can see how the channel changes from when our model's on a buy signal indicating a bull trend. This is where we expect the market to trade. When we switch to the sell signal as we did in April, now we expect the market to trade in this channel, right? And you could see the oversold reading in June, now the overbought reading, assuming we stay in the bear cycle. A similar time that we could look at is back here in 2018. You can see we were in a bull trend. Prior to that, our model switched to a bear trend, a sell signal in, I believe it was September of 2018, and you could see how the market traded in this bear channel. There was a similar selling climax signal on Christmas Eve, right at that low or near the low, very similar to what happened this July. And then as the market recovered, our model flipped back to positive, and then we assume we're back in a bull cycle, and we change from wealth preservation to wealth accumulation mode with our strategies. Now this, is a short bear market, and it happened without a recession. Right? So if, again, no recession, we could see a similar outcome where we move out of the channel, we start a new bull cycle. Moving out of the channel does not define starting the new bull cycle, but we would, if we do get the global buy signal based on our core indicators, then we would look at a potential bull cycle setting up and expect the market to trade in, that upward sloping generally channel. Right? If scenario B plays out and a recession does develop, then we could remain in this bear channel for quite some time during long bear markets and see, further legs to the downside. So in summary, from an economic standpoint, there still are some conflicting signals. Inflation has come off of its high that could encourage the Fed to reduce their interest rate hikes moving forward and eventually pause them. In our view, that'll take a lid off of the stock market, and there would be good opportunities developing in that scenario. In the scenario where they continue to increase interest rates, or the interest rates increases they've already made eventually affect the economy. Usually interest rate movements have a 9 to 12 to 15 month lag. So it's unlikely that when they started raising interest rates in March, that caused some of the economic weakness we're seeing now. It could cause economic weakness next year. And if that happens, it's likely that our recession warning models will more definitively warn of the recession and alert us to it. Then we would look for scenario B to play out in the market, which would mean a longer bear cycle that could extend well into 2023, and looking at some further downward movement in stock prices more than likely. So we're keeping our options open and not getting cornered into one way of thinking. We want to be flexible and dynamic in our thought process, and we'll continue to relay our findings to you in our upcoming updates. And if anything happens in terms of signals with our models in between updates, we'll be sure to send out a flash alert to inform you. Thanks for watching, and have a great weekend.